It gives me great pleasure to welcome a rare guest on ET Now, someone I have always looked up to, someone everyone looks forward to for his understanding of the financial sector, to understand which way the economy is headed, and also what lies ahead for India in this kind of and rather tumultuous environment. Mr. K.V. Kamath joins us now. Mr. Kamath, what a pleasure to have you on ET Now. Thank you for joining us.
Thank you.
The headlines which are coming on the macro front and also on the global economic front are nothing short of scary. Indian economy has done rather well so far, sir. But given our size and given that we are connected to what is happening in the world, how long do you think we can remain Teflon coated, if I may use the word?
We have a runway of 25 years and we are going to exercise it. And we will be a 25 trillion economy in those 25 years. I want to make that upfront. Now let's look at the challenges, the global challenge that comes up, and let's see how we are insulated. I think the way we have come out of COVID and the way our the entire corporate ethos, the way it has now looks. You have deleveraged corporate India. You have deleveraged balance, completely deleveraged balance sheets. You have clean balance sheets in the banking business. You have strong cash flows in corporate India. The like of what I've never seen. So that is one, which is key for looking at whether a country is going to grow or not. You come to the second layer. Do you have an investment opportunity? Because you may have all these strengths, but if you have no investment opportunity, it is not going to work. Again, as I said, our runway is 25 years. Why? We have a tremendous amount to do in getting our water management right. With that will come agriculture, with that will come animal husbandry. We have a lot to do in the infrastructure sector, and in the water side and in part of the infrastructure area, particularly roads, rail, government is required. The rest of it, the private sector has been, I think, running with the ball. Green power, 3 or 4 other sectors that come on to mind, telecom, ports, and so on. The private sector is running hard with the ball. Manufacturing, with clean balance sheets, with cash flows that I have not seen in my 50-year banking career. I think we can meet any growth requirement that we have, greenfield or brownfield, with hardly any debt, maybe marginal debt in a greenfield, but hardly any debt. Then you have the services sector, which was going on wonderfully well, and I believe will go on well. And icing on top of this is the digital economy. The digital economy, let's put it in context. Reported numbers, 70,000 companies. I go a little forward, I move a little forward. I estimate that 20 people per company. That is roughly 1.5 million employees. When we did the last look 20 years back at white collar employment that happened through the IT business, we said 5 to 6 jobs per every IT job created. I think that's the same thing is happening here in this case also. So if you have 1.5 million people in this business, the digital side of the business, and they are creating 6 other linked jobs, you're talking of roughly 9 to 10 million jobs that are already happening there. Not counting the new jobs which will be created because this sector is growing at a pace. So given all these things, and so you have an investment path, there is investment need, there is investment ability because of the clean balance sheets. More important, I think we have given our policymakers have given a conducive environment in terms of interest rates where everybody can thrive, whether it is the manufacturer or their consumer who is going to borrow. Interest rates have been kept at a level where you can grow. And I think by doing this, a new model has been shown that it is not necessary to follow 100-year-old theory of inflation and interest rates, as Europe and US have done. But in our case, I think we have managed it excellently well with interest rates slightly below inflation, targeted inflation set to come down. So I think you have created an environment for growth. So I would think that global challenges notwithstanding, we are in a good place. Yeah, there will be some I would say as turbulence as things happen in the West, but I don't think this is going to impact us even for an intermediate period.
Mr. Kamath, some would argue and say that the bedrock for any economy is interest rates, which is a function of global moving parts. If the US Fed increase is going to be increasing interest rates, that may be a bit of a challenge for Reserve Bank of India, as they will have to protect the currency as well. And if interest rates they go higher, at some point in time, whether it is retail borrowing ability or affordability, it will get challenged.
It's a very interesting. And again, I think we need to look at what is happening in a total, take a holistic view. Yes, US, you describe what is happening, and US is taking certain corrective steps. But look at what is happening from UK, Europe to Japan. Japan, I think over the last 1 year, the currency has gone down almost, 35 or 40%. And in, what has happened in Europe and the UK. In real terms, Europe is near about 8 to 10% negative interest rates. So given all these things, how do you manage your currency? And I think what the Reserve Bank has done is the rupee has strengthened against these three currencies that I mentioned, whether it's the pound, the euro, or whether it is the yen. And you have, of course, weakened against the dollar, but not as much as other currencies have. So I think it's a very interesting time of flux. And in this, we hear this phrase increasingly talked about, the de-dollarize the economy. So I'm sure we will look at how is it that we could de-dollarize. Could we do some netting out? Could we do some trade in local currency, our own currencies, and so on? I think interesting things are, which I have not seen in 50 years, I think are going to happen. So in this part of it, the strong currency that is there with one country may not be as much of a challenge as it could have been, because there are other offsetting items here which could play very well into our hands, and indeed they are playing into our hands. So I'm not worried about that. So what I would be only looking at is, do we have a conducive path for growth? Yes, we have. That is low interest rate, strong balance sheets, lendable capacity with banks. Do you have a runway where there is a need for investment? Clearly, yes. So given this, and of course, there is a new driver, which is Digital India, which I believe is going to be from 5% of the economy today, in the next 5 to 6 years, 25 to 30% of the economy. So I would think that at this point in time, I am more bullish than I have ever been in my 50 years career in the banking business.
Mr. Kamath, whether it is geopolitical tussle or the ugly reality of world, we are going through an energy crisis like never before. And India is still dependent on other countries for their energy imports. Could this really be the chink in the armor that you want to grow, but where energy cycle is moving, and given what is happening at the geopolitical level, the demand for the new hungry energy India and meeting that demand will be a challenge?
I think, yes, if again Western demand peaks for oil, and you go through oil, going through 90 and 100, we will have to be careful. But we are looking at a 3 to 4 year window before we start building massive alternate energy, meeting our requirements for alternate energy. And I believe that itself will be a momentum provider. So I look at this challenge as a positive, because that will put us on a, I would say, Atmanirbhar basis to make what we want in terms of energy, and also that investment will drive a further growth for the economy. So I'm not as pessimistic as I could have been if this correction had not taken place and corporate India had not responded, and also the government in terms of the firm articulation of strategy was not there. I think all this is there. So it will be a short period. We'll have to be careful. Just now things are looking good. Oil is down. Global demand probably will come down. So that gives us a window, and we should seize that window.
I'll just extend my appointment with two more questions, Mr. Kamath. We've historically looked at China as the benchmark. The way China has really evolved as an economy, that in a sense became benchmark for us. Do you think it's high time we start thinking independently, and we need to put that good old China comparison on a back burner?
Yeah, I think the time has certainly come, since as I can see in almost all areas, particularly in the digital front, we have caught up, and we now are probably racing ahead. Where we were probably behind was in getting and pushing manufacturing. I think we clearly are now running because we have a huge domestic demand, and with China +1, Europe +1, we have a global demand also. So, and we were in the last 4 or 5 years clearly efficient, are getting more efficient over the last year. And COVID, I believe, has allowed us to extract maybe a 20-25% productivity gain. If you look at actual numbers of corporate India, because otherwise I'm not able to figure out how your profitability can grow at plus 25%, and of course what you're paying to the government also growing at these numbers. So clearly, I think corporate India is a competitive engine today. They have got a competitive machinery with them. So this benchmark that we are doing in the past system, could be some areas where we could probably now try and exceed, and that is in execution. And I think, again, the government is seized of this as to what could be slowing down execution, and make sure that those whatever things that slow down are pushed to the side. And we have, particularly if we can do that in some areas of infrastructure, I think we are all set. So I think benchmarks, we should not do any more benchmarks at all. We have our own, I think, next level that we should set as our benchmark rather than look at any other country.
So final question, sir, and something which in a sense now seems to be occupying a lot of public debate. That, and I'm speaking, and this question is perhaps to Mr. K.V Kamath, the banker. Do you think it's high time that the rating agencies take notice of what is happening in the world and change their ratings for European countries and increase ratings for India?
I think we have to make this as our mission in terms of how to get the rating agencies to look at India in an appropriate manner and the West in an appropriate manner. I can say this, Nikunj, my experience with the global rating agencies from the perspective of the BRICS Bank or the New Development Bank clearly indicates there's a whole lot of, I'd say, history in the way they have gone about their ratings. And the yardsticks they use are clearly flowing from the West. I think we need to present our case in a much more, I would say, forceful manner, which I'm sure is being done now, to make our point that those yardsticks are not applicable. Draw all sorts of, I would say, outcomes that we have seen in the West. And, again, I have not seen any rating downgrade given the sort of numbers. Imagine if we were as profligate as the West, what would have happened to our rating today? So I would think that this case is now could be made much more in a stronger manner than in the past. And there is a case to relook at Western ratings and clearly to re-rate India upwards.
But sir, do rating agencies really matter? I'm asking a direct question here because looking at the experience of where India rating is and the kind of flows we've got, at least in the bond market, I'm keeping equity market aside, rating agencies are a crucial benchmark, but frankly, their edge now seems to be reducing.
Yeah, actually, if you go along, since, we need to also ask a question. In the Indian context, how relevant are the rating agencies? If we can get our interest rate equation right, if we can make sure that the currency is stable, I think, honestly, the rating agencies don't come in as a critical force for us unless we want to borrow huge amounts. And the rating number there could determine the cost at which you will borrow. But I'm sure, Nikunj, even there, it is, let us assume that we can do not necessarily with the rating agencies, but we need to get the rating right because all said and done, still it is a number that people look at for a variety of reasons. So I'm sure we will communicate in an appropriate manner the strengths of the country and look at